We now continue with our third session, diving into one of the most urgent and transformative forces shaping our industry. The topic, sustainable insurance and green finance, driving ESG integration. This session will be moderated by Mr. Willie Ignatius from Board of APRA. Our distinguished speakers include Ms. Geraldine Ang, Team Lead, Clean Energy Finance and Investment Mobilization, OECD. Joining us through a special video message, Mr. Hakimul Batih, Indonesia Programmer Representative, Clean Energy Finance and Investment Mobilization, OECD, and Ms. Suzanne Smith, Executive Board Member, Australian Prudential Regulation Authority APRA Chair, IAIS Audit and Risk Committee.
Very overwhelming. First time on a circle stage. Bapak Ibu, good morning, good afternoon, ladies and gentlemen. Welcome to Indonesian Insurance Summit 2025, Reimagining the Future of Insurance, Innovation for Sustainable Future. My name is Willie Ignatius Senepar. I will be your moderator for this session. We will start our third session about sustainable insurance and green finance, driving ESG integration. Our speakers this session Ms. Geraldine Ang. Unfortunately, she is not here, but she will be on a video online. She is the Team Lead, Clean Energy Finance and Investment Mobilization, CEFIM, Organization for Economic Cooperation and Development, OECD. Next is Mr. Hakimul Batih, Indonesia Program Representative, Clean Energy Finance and Investment Mobilization, Organization for Economic Cooperation and Development. Also, Ms. Suzanne Smith, Executive Board Member, Australian Prudential Regulation Authority, APRA, Chair, IAIS Audit and Risk Committee. I can probably read through a short bio of the speakers. Ms. Geraldine Ang, she has authored several OECD reports, including the new reports on overcoming barriers to the international investment in clean energy. Prior to joining OECD, she conducted research on the economic of climate change, mitigation for the Earth Institute. Pak Hakimul Batih, Pak Hakimul Batih has been facilitating coordination between various government ministries, such as the Ministry of Energy and Mineral Resources, Financial Services Authority, OJK, Ministry of Insurance, Ministry of Industry, Ministry of National Development Planning, Bappenas, Ministry of Finance, coordinating Ministry of Maritime and Investment Affairs, and coordinating Ministry of Economic Affairs, development partners, and other stakeholders to ensure timely inputs and delivery of the program. Ms. Suzanne Smith was appointed Executive Board Member of APRA in October 2022. responsible for the general insurance, life insurance, and private health insurance sectors. Prior to joining APRA, Suzanne's career included senior roles across the superannuation and financial services industries in areas including life insurance, funds management, asset servicing, alternative investment, wholesale banking, and property. Now we'll start the session. The insurance and financial sectors, with their ability to influence capital flows and assess risks, have a pivotal role to play in building a more sustainable and resilient future. How can insurers embed ESG into underwriting, product design, and investment portfolios? What does meaningful ESG integration look like in practice? Not just in reporting, but in impact. Today, we are not just talking about risk, we are talking about responsibilities. And more importantly, we are discussing the opportunities that emerge when purpose and profit align. Let me remind the audience, everyone, that at the end of this presentation, we will open a Q&A session from the floor, or you can also come to slido.com and put your questions there. At the end, we will answer and discuss after the presentations. Ladies and gentlemen, first of all, let's watch the videotape from Ms. Geraldine Ang, Team Lead Clean Energy Finance and Investment Mobilization, Organization for Economic Cooperation and Development.
Selamat siang and good morning and good afternoon. My name is Geraldine Ang and I lead the OECD Clean Energy Finance and Investment Mobilization CEFIM program on energy. Many thanks to the Insurance Council of Indonesia, DAI, the Indonesia Life Insurance Association, IAIS, the Financial Supervisory Authority, OJK, and all of the participating Indonesian insurance associations for the kind invitation to speak virtually today. I send my warm greetings from Paris and offer my sincere apologies for not being able to be with you in person today in Bali. Thankfully, my colleague Pak Batih Hakimul, who coordinates CEFIM program in Indonesia, is attending today's summit and will be able to provide you with insights on our work and address any questions you may have after my presentation, with many thanks in advance to him. Let me very briefly introduce the OECD for those of you who are not familiar with this organization. The Organization for Economic Cooperation and Development, or OECD, is an international organization that works to build better policies for better lives. We work closely with policymakers, stakeholders, and citizens to establish evidence-based international standards and to find solutions to social, economic, and environmental challenges. The OECD brings together 38 member countries, spanning from North America and South America to Europe and Asia Pacific. In terms of global reach, we work with more than 100 countries as a global policy forum that promotes policies to improve the economic and social well-being of people around the world. And in addition to the 38 member countries, the OECD has close engagements and collaboration with 5 key partners, including Indonesia, and 8 accession countries, including as well Indonesia. And let me highlight that very specifically, as this is very core to our collaboration with Indonesia, that Indonesia is one of the OECD's 5 key partners since 2027. We have an office in Jakarta since 2015, and Indonesia and the OECD have had very close relations, which were further strengthened during the 2022 Indonesian presidency to the G20. And we are so pleased that in February last year, the OECD Council made the historic decision to open accession discussion with Indonesia, marking a significant milestone in our partnership. And we look very much forward to deepening the relationship between the OECD and Indonesia in the upcoming years. And today's summit is a testimony to this collaboration. In the context of today's discussion, let me very briefly present the OECD Clean Energy Finance and Investment Mobilization Program before to dig into the heart of the topic, which is insurance. The OECD CEFIM program collaborates with several emerging economies, including Indonesia, to strengthen domestic enabling conditions and develop policies and instruments to unlock private finance and investment for clean energy, including in renewable energy, energy efficiency, clean hydrogen, and industry decarbonization. And we work through demand-driven, tailored collaboration with several partner countries, including in Indonesia, OJK, with whom we've established excellent collaboration, and we're very grateful for this. Typically, how do we work? We start by developing a whole of government and multi-stakeholder engagement approach to develop clean energy finance and investment policy reviews or roadmap that tackles, key barriers and policy recommendations for unlocking investment in clean energy in a dedicated country. And in Indonesia, we launched the review back in 2021. And building on the recommendations of the review in Indonesia, we've collaborated very closely with the Ministry of Energy and Mineral Resources, MEMR, with the Financial Supervisory Authority, OJK, with the Just Energy Transition Partnership, JETP of Indonesia, and other partners to develop several tailored implementation support activities. I won't name all of them, but it includes a very successful staff on loan program with OJK. For example, last year we worked on developing guidance on energy efficiency financing, a guidance on transition planning, capacity building on clean energy, broadly speaking, as well as work to the JETP Secretariat on guarantees and energy efficiency financing. Now, in terms of human capital development specifically, Pak Batih Hakimul, our coordinator of CEFIM based in Jakarta, who's here with you today in the room, has been developing for the past 3 years a very successful clean energy finance and investment training week to break silos between the finance and energy communities, to share knowledge and develop co-financing solutions that can scale up private finance for clean energy in Indonesia, joined with OJK, MEMR, and last year, the JETP of Indonesia. And I will say that putting together different communities, the insurance community with the energy community, is one of the key priorities we see at CEFIM in order to create a pipeline of bankable projects, products, and services. Now, very quickly to the JETP Indonesia, we provide support on guarantee instruments for clean energy, on financing instruments for small-scale, high-risk renewable project, and on energy efficiency financing. Now, let me very briefly highlight more specifically our activities on energy saving insurance, because this is what you're mostly going to be interested in today. And Pak Batih, as I said, will be able to answer any questions you may have. The first thing is that the insurance sector as a whole has a critical role in better assessing and managing climate-related financial risk. The insurance sector is uniquely positioned, building on centuries of experience and tools on risk modeling and management, given the significant risk that climate change poses not only to financial performance for the financial sector, broader financial stability and even price stability, but also to economy and society at large. And beyond providing financial protection, insurance can play an important role in identifying assets at risk, encouraging risk reduction and adaptation, and providing confidence to investors to invest in a pipeline of bankable projects. Now, the challenge is to shift the traditional focus of the insurance sector on financial and credit risk to also better assess, measure, and manage climate-related and broader environmental risk. And the focus of research and supervision of the insurance sector has often focused on physical risk exposure. So quantification techniques and models explicitly cover transition and liability risk. On the contrary, are less frequent and at early stages, even in the most developed jurisdictions. But what's interesting, however, is to notice that financial authorities that have assessed climate risk through a system-wide stress test have found very interesting results. For example, a recent climate stress test by the French Prudential Supervision and Resolution Authority, the equivalent of OJK in France, found that insurance undertakings, be it in the short or long term, are significantly exposed to climate-related shocks. And I should stress that OJK is also working on such stress tests. Now, specifically on energy saving insurance, what have we been doing at CEFIM and the OECD? We collaborated with OJK and the government of Indonesia for now almost 2 years to develop a series of knowledge sharing and capacity building events and stakeholder dialogues on energy efficiency investment and the risk mitigation instruments like energy saving insurance that can be set in place in the Indonesian markets. We started off with an international focus group discussion on ESI in 2003. We followed with a public-private dialogue in May last year on the topic. And building on that, we developed a draft needs assessment study to implement energy saving insurance in Indonesia. And we tested some key preliminary findings of the needs assessment study during a workshop we organized in January this year in Jakarta, joint with OJK, MEMR, and colleagues. Now, you're going to ask me, what is energy saving insurance, or ESI? And it's a scheme that has been very successful, for example, in Latin American countries, and with huge potential for being implemented in Indonesia and other Southeast Asian countries. So I would say, in addition to assessing risk, the insurance industry has a critical role to play in creating new financial products and services that can help unlock a pipeline of real economic clean energy projects in Indonesia to support not only financial performance of companies, MSMEs, but also energy security, energy access and affordability, economic competitiveness, job creation, while also contributing to local air pollution and climate mitigation. And in this regard, the energy saving insurance scheme provides a very promising model for financial institutions and especially insurers in the room to consider in Indonesia. The ESI model is a risk mitigation package that consists of financial and non-financial elements designed to build investor confidence in energy efficiency projects. It has 4 main building blocks that support the identification and structuring of technically robust and bankable projects. First, a standardized contract that establishes the responsibilities of the supplier and the customer in terms of supplying and installing equipment, guarantees, maintenance, and the promised energy savings related to a benchmark and payments. Second, the technical validation, which is carried out by an independent agency, and that's an important aspect to be independent, that evaluates and confirms the project's technical potential to achieve the promised savings and verifies on site that the project has been implemented and that the technologies installed are approved according to the specifications pre-approved in the initial evaluation. And this is, of course, indispensable for insurers to have the confidence to develop such insurance product. And fourth, the energy saving insurance in itself is a performance guarantee provided by the supplier third, it's a performance guarantee provided by the supplier to the customer for the committed savings that have previously been agreed between the two parties. And fourth, insured projects are often financed with concessional or green credit lines, and lender can provide preferential terms under these credit lines, including preferential interest rates, grace periods, and extended tenures, usually set up by donor agencies or multilateral development banks. And you see here the summary of the scheme. Now, in terms of the risk coverage under ESI products, I should stress that ESI typically cover operational risk, unlike other types of risk. In collaboration with OJK, last year we conducted, as I mentioned briefly, a needs assessment study for an energy saving insurance scheme for Indonesia, including a SWOT analysis, strengths, weaknesses, opportunities, and threats. So on the strengths, what did we find out? Of course, that the government of Indonesia is very committed to enhancing energy efficiency, has put in place several programs as well as partnerships, including with international organizations to strengthen capacity of local stakeholders. Second, weaknesses. The Indonesian market has, however, several weaknesses, including low awareness and understanding of the potential and benefits of energy efficiency amongst the industry, insufficient number of energy saving services companies or ESCOs, and independent monitoring and verification entities available in the market, as well as limited available financing mechanism for energy efficiency. On the opportunity side, at the same time, of course, the large untapped potential represents an interesting opportunity for the ESI model to help scale up investment in energy efficiency in Indonesia. Over the past years, demand for sustainable and green investments in Indonesia has been increasing. Existing insurance instruments in the form of contractual liability or surety bond could be adapted to an ESI product. And there are a range of international organizations and development banks and bilateral donors operating in the region and Indonesia specifically, which cover energy efficiency financing, technical insurance, assistance, capacity building, which opens opportunities for collaboration between public, private, and those development actors. In terms of threats, what did we find out? For the uptake of ESI in Indonesia, there are competing investment priorities of potential project owners, and particularly MSMEs, who might prioritize investment in the production or more generally operation of their business rather than energy savings. And the subsidized electricity tariff currently provides little incentive to invest in energy efficiency measures that would reduce the energy cost. And lastly, based on the limited awareness and understanding of energy efficiency in the market, supporting measures to strengthen capacities and raise awareness amongst financial institutions, ESCOs, energy auditors, and end users are needed to ensure sufficient uptake of ESI product. I will stop now and let my colleague Pak Batih Hakimul present in the room with you the next steps of our work at the OECD under the CEFIM program in close collaboration with OJK and MEMR, including the setup of a new ESI task force and possible additional work to develop an ESI implementation roadmap. And throughout this process, let me reassure you that we will continue continuous and strong stakeholder consultations with all of you in the room that are interested to participate, financial institutions, insurance companies, energy services companies, and other market actors in Indonesia. Thank you very much for your attention. I'm sorry again I could not join in person today. I look very much forward to our continued collaboration in advancing clean energy finance and investment in Indonesia. Very grateful for the collaboration with OJK and want to flag that all our reports, activities, and trainings are available online. And now I will pass the floor to Pak Batih Hakimul. In case you have any questions, Pak Batih will be able to answer them. Thank you.
Okay. Thank you, Ms. Geraldine. It's a lot of insight, very interesting, and even more interesting when we have a more elaboration from Hakimul Batih later on. But before that, let me go to Ms. Suzanne Smith to hear about more explanation from her. The stage is yours.
Thank you very much for the opportunity to be here today in beautiful Bali. It's actually about 35 years since I was last in Bali, and since coming back I've realised I've waited far too long to return. My name is Suzanne Smith and I am the Executive Board Member at the Australian Prudential Regulation Authority, known as APRA. And I'm also privileged to be an executive on the EXCO of the IAIS and also the chair of the Audit and Risk Committee of the IAIS. It's a pleasure to join you today at the second Indonesia Insurance Summit, and also incredible to be here with 600 leaders of the insurance industry in this region. Thank you for having me to talk about the approach that APRA takes to ESG integration. Sharing information, expertise, and insights is important as our two economies navigate the shared challenge of both energy transition and managing the effects of climate change. Before joining you here today, I've just spent 2 days in Jakarta, where I led a delegation of colleagues from Australia and held meetings with the OJK, Ministry of Finance and Bank of Indonesia. They were excellent meetings where we spent time sharing information on our progress and challenges relating to climate change, sustainable finance, and the insurance market more broadly. Australia values the partnership that we have with Indonesia, and our Australian Prime Minister, Anthony Albanese, was here in Indonesia last week, and he stated that Indonesia is our most important partner. For those not familiar with my organisation, APRA is the prudential regulation of the financial services sector in Australia. We regulate all banks, all insurance companies, and all pension or superannuation funds. The banking sector comprises $5 trillion of assets. The superannuation sector follows closely behind it, now $4 trillion. And the insurance industries of life, health and general cover about 300 billion. But really the role of insurance is all about confidence in the market, and the impact is far broader. In the insurance sector, we regulate 89 general insurers, 34 life insurers and 30 private health insurers. But like in many markets, there are generally 2 or 4 dominant players in each of those areas. The key role of APRA as the prudential regulator is to ensure that entities properly manage risk to maintain confidence in the market. Climate change is now posing challenges to the stability and resilience of the financial system, and so incorporating consideration of ESG into our regulatory work is essential. ESG integration for us as a prudential regulator does not mean prescribing particular lending decisions. What it does mean, though, is that we set standards requiring regulated entities to have policies and procedures in place for governing their activities to maintain sound financial risk management and ensure financial resilience. To that extent, ESG factors have implications for financial risk. We would expect prudent entities to consider these in their decision making. And we look at that from 3 dimensions. Physical risks, such as the changing climate conditions and extreme weather patterns. Transition risk, including changes to policy, technological innovation, or social adaptation. And liability risk, which may involve stakeholder litigation, disclosures, or regulatory enforcement action. In Australia, we've been focused on climate risk for a number of years now, and in my presentation, I will refer to the following activities which all contribute to ensuring our entities have the right processes and frameworks in place to appropriately manage climate risk so they can continue to meet their financial promises. These include the prudential guidance that we issued on climate change financial risks in November 2021, the Insurance Climate Vulnerability Assessment, which is currently in progress, and the climate vulnerability self-assessment work undertaken by all our regulated entities. Further, in our corporate plan, APRA sets out a strategic objective to respond to significant and emerging risks. And a key initiative here is lifting expectations on our entities to consider the financial impacts of climate risk in their decision making. So why is managing climate risk so important? The impacts of climate change are not theoretical for Australians. We are experiencing the impacts through more intense cyclones, longer and hotter fire seasons, and the increased frequency and extent of riverine floods. Earlier this year, in March 2025, ex-tropical cyclone Alfred was set to hit our 3rd largest city, Brisbane, with a population of nearly 3 million people. This would have been the first time in 50 years that a cyclone has hit a major population centre so far south. Ultimately, the cyclone weakened in strength to a tropical storm, but not before it unleashed significant damage and fear across our community. And it brought to the forefront of everyone's mind that climate risk has real consequences, even for our major population centres. And that's just one of the natural disasters Australians are sadly becoming more familiar with. We also face more extreme bushfires. Warmer, drier conditions are fueling severity and frequency. And the fire season is starting earlier and finishing later. The cost of extreme weather is growing in real terms. Averaged over the past 3 decades and adjusted for inflation, insurers paid $2.1 billion a year to policyholders impacted by extreme weather events, compared to the last 5 years, where it's more than doubled and has reached an average of $4.5 billion a year, with floods the main driver of this increase. The main factors driving up the disaster costs are the expanding development and urbanisation, particularly in areas of the country at higher risk of being impacted by natural catastrophe. The upward pressure on premiums from these factors, even before climate change impacts are fully felt, underscores the urgent need for land reform, land use planning reform, improving building standards, and implementing programs such as property buybacks in the most vulnerable areas. Now I'll speak about how climate risk manifests in insurance. Insurance is an important economic safety net. Insurance helps people get back on their feet after disaster strikes. For homes, businesses, communities, it gives people peace of mind. This aids economic recovery. The financial system also relies on insurance for lending protection, and insurance coverage can help to reduce the need for public spending post-disaster. Yet APRA has noted insurance premiums have seen double-digit percentage increases over the last year, exacerbating insurance accessibility and affordability. The worsening conditions in the previous slide are the main drivers of these rising premiums. And this has resulted in a widening protection gap, with some households deciding to underinsure or cancel policies altogether. And while nowhere near the protection gap being faced by Indonesians or in this region, around 15% of Australian households now face unaffordable general insurance premiums. Floods are the main driver, but also fires and cyclones, and the risks are concentrated in regional Australia. This gap threatens not only individual financial security, but also the broader economy, with underinsurance or non-insurance having the potential to leave many Australians unprotected when disaster strikes. And climate change means that disaster is striking with more ferocity and greater frequency. The most sustainable option isn't to fix the gap through subsidies, which will cost everyone. Instead, all stakeholders should focus on risk reduction to improve affordability. And there's a growing body of evidence that emerging that shows for every $1 spent on risk mitigation, $9 can be saved in remediation costs after the event. The Australian government has set up mechanisms such as the Australian Cyclone Reinsurance Pool, the Hazard Insurance Partnership, bringing together many areas of government and private industry, and has also invested in infrastructure such as river and bank levees to make communities safer and more resilient. These are good examples of risk mitigation. Risk reduction requires good decision making on the part of our entities, but also government and consumers, and clear information on climate risk. Our insurance climate vulnerability assessment, which I will touch on later, will give a more informed view of how the insurance industry may evolve between now and 2050. A key objective of the assessment is to identify areas where adaptation needs are high and may need to lead to larger insurance protection gaps in the future. By focusing on these gaps, APRA aims to improve the understanding of how climate change may affect insurance affordability and availability in the future. This work is crucial in ensuring that our regulated entities, government and communities can be better informed and prepared for future climate-related events and access to financial protection. So once again, I'd like to acknowledge that in global terms, compared to Indonesia, the insurance protection gap in Australia is relatively low. And this is one reason why we see our work and participation in global forums such as this summit and other groups such as the International Association of Insurance Supervisors, the IAIS, the Network for Greening the Financial System, the NGFS, the Asian Forum of Insurance Regulators, and the Global Asia Insurance Partnership, along with bilateral relationships. These are central to trying to support collective improvement across the world. Let me now share more about our work relating to climate risk. Because climate change poses a challenge to the sustainability and resilience of the financial system, our work is focused on getting our regulated entities to embed and integrate climate risk in their financial decision-making and governance processes. Some examples of the work that we've done to help embed this is the work on our prudential guidance, which was issued in November 2021. APRA's guidance helps regulated entities manage climate risks within their existing frameworks by encouraging them to build capacity within their organisations through investment in people, processes, systems, and metrics. This guidance offers a flexible approach, encouraging scenario analysis and stress testing for insurers to assess and disclose climate risks. We have also run climate risk self-assessment surveys, and the survey was designed to help APRA understand how our regulated entities manage and disclose climate financial risks and align their practices with our guidance, as well as recommendations from the Task Force on Climate-Related Financial Disclosures. It was a very helpful way for us to benchmark maturity of our banks, insurers, and our pension funds. And the results so far indicate that there is broad alignment to APRA's guidance, with climate risk starting to be embedded into governance and elements of risk management framework. But it also showed there was more work to do on metrics and targets, where the use of more advanced quantitative metrics such as financial emissions and forward-looking exposure to physical and transition risk was generally limited. It's also very helpful when we provide results of the survey that compare insurers to their peer, which is always a cause for action. I'll now speak about the important work that we're currently undertaking called the Climate Vulnerability Assessment, or the CVA. We know that Australia is facing amplified cyclones, longer and more dangerous fire seasons, greater risk of riverine flooding and coastal inundation. Climate change is therefore making insurance more expensive through more households being in harm's way, rising cost of reinsurance, greater risks and uncertainty, and more expensive building costs. Information is key in helping entities embed and integrate climate risk in their decision-making and governance processes. Entities as well as government need up-to-date information to allow an accurate assessment of the risks faced. And clear information can also help government target funding to where it's most needed to increase resilience by highlighting where the highest risks are and who is most exposed. In that vein, the key objectives of the Insurance CVA are to understand the future changes in the affordability of general insurance over the medium term under two potential climate change scenarios and how those changes vary by location and risk, and contribute to the system-level understanding of how changes in affordability could impact the general insurance industry. And also inform government, policyholders, the community and insurers on the potential evolution of the challenges to the affordability of general insurance in Australia. The CVA focuses on understanding extreme weather peril risks and home insurance premiums that could be faced by households out to 2050 under the two climate scenarios and how this may impact affordability. And this comes as the rise in insurance premiums makes up a large part of domestic inflation in Australia. The two climate scenarios have different economic, emission and temperature pathways, resulting in different degrees of transition and physical climate risks. To support the comparability of responses, common economic variables have been provided to participating insurers. This is an extensive data collection involving Australia's 5 largest general insurers and covering 80% of all Australian households. The modelling work is undertaken by insurers, and APRA will then aggregate the data to draw insights from the analysis. And while this work is a form of stress test, it is not a traditional capital and liquidity stress test of an insurer. It's more about looking to the future to determine the impact of changing climate on access and affordability by determining where the risks are and the timing of where they may emerge in the future. This is about determining risk to customers. This work follows work that we did recently in the banking sector, which was different in that it was about risks to banks. In this case, we looked at credit risks of banks through their mortgage and business banks, including exposure to high-emitting industries. So to finish, I want to share the work APRA is doing also alongside the Australian government and other agencies, such as our conduct regulator, the Australian Securities and Investment Commission, and the Reserve Bank of Australia on initiatives in our Sustainable Finance Roadmap. The roadmap includes 10 key initiatives with a focus on 4 key areas in the first phase. These include climate-related disclosures, sustainable finance taxonomy, transition planning, and product descriptions. I also commend Indonesia through the OJK, the Ministry of Finance and Bank of Indonesia for the work being done on Indonesia's Sustainable Finance Roadmap, covering many of the same areas to map out a pathway for sustainable finance in this country. This work on our Sustainable Finance Roadmap, in conjunction with all the other initiatives I spoke about, are important steps to not only position Australia and the financial system better to address the emerging risks, but also to try to help change the trajectory and impact that a changing climate is having on our world. So once again, thank you so much for having me today. It's been a privilege, and I look forward to any questions. Thank you.
Thank you, Suzanne, for the presentation. Very interesting. We'll now start answering questions. Within the time constraint, I'll keep it within the slido.com. But before we answer question, I'd like to turn around to Pak Hakimul Batih. I mean, can you sort of like elaborate about the ESI task force and ESI implementation roadmap, as mentioned by Ms. Geraldine in her videos?
Thank you, Pak Willy. Assalamualaikum warahmatullahi wabarakatuh. Thank you for having me in the very important event Indonesia Summit, Insurance Summit 2025. To respond on that, Pak, actually this initiative is come from OJK under the leadership of Pak Angga. I believe Pak Angga is in the room now. This is the idea was to identify who does what, Pak. The task force is identify who does what, the role of each institution to implement the energy saving insurance in Indonesia. And on the roadmap, I believe this is the follow-up of our successful program here with OJK also. The secondment program. Under the secondment program, the staff on loan of OJK staff is placed in our head office in Paris. And under that, we develop like need assessment. And the follow-up of the need assessment is the implementation roadmap. In the roadmap, it will outline the priority sector and also the market opportunity, implementation plan, and also the timeline. So 2 points I will highlight here that the task force and roadmap show the important support from the OJK and government. So this is clear message from the OJK and the Ministry of Energy that they support the development of energy saving insurance in Indonesia. So I would like to invite all the leaders here to contribute to that, because they will be rolled out most likely this year, next year, to implement the energy saving insurance in Indonesia. Thank you.
Okay, well, be more questions to you, Pak Hakimul Batih, but I think we'll switch a little bit to Ms. Suzanne. In your view, how can emerging technologies like AI, blockchains, big data help insurance enhance sustainability, performance, and transparency? Are there risks we need to anticipate when developing these tools?
Thank you very much. We're seeing the use of artificial intelligence, AI, starting to come through more in the Australian market, and I thought I can perhaps give 3 examples. Recently, in my talk, I just mentioned we had the cyclone coming through, and one of the tools that was available to insurers was some work that Google AI had done on predicting the trajectory of the pathway of the cyclone. And it was actually incredibly accurate compared to some of the traditional models. And so I think that is an opportunity for smaller insurers who may not have access to technology to think about using those types of tools as they're starting to think about where risks emerge. I think AI in servicing customers better. Your customers are so important, and trust is a foundation of insurance. And so if you can speed up the process of the claim by working through the information and being able to pass a customer on to the next customer service person easily because the information's synthesized, that's really important. A third one is even in the broker market, when you're getting a lot of applications in, if you can use AI screening up front to look at whether the application is complete. So many times applications sit there waiting only to be turned around at the end to say we need more information. So we've seen some examples in the global market where insurers are adopting that type of technology. But we know that there are risks with AI. We know that it can result in financial exclusion, and that's a real problem in a market where we actually have low penetration. So we need to make sure bias doesn't creep in. And we also know that AI is only as good as how we train it. And so it's learning from us all the time. So we need to keep watching for the gaps that might emerge there.
All right. Let me just read one of the questions. What regulation, this I think for Ms. Suzanne, what regulation or incentive does APRA have for the insurance industry to expand climate-related coverage, and how is the Australian government involved?
So APRA is a risk-based regulator, and we expect our regulated entities to be looking at all the risks that they face, and they're both financial risks and non-financial risks. Climate risk is another risk that is real, and so we're looking at how entities are incorporating that financial risk into the strategies and the work that they're doing. So we have our prudential standards that requires them to look at risk. We have capital settings that we can use that to the extent that we see gaps And as I talked about, the guidance and the self-assessment surveys. So they're really important inputs for us to look at who's doing it well and who is lagging. The work that the government is doing with the regulator is really important because no one can solve this on their own. And so in every country around the world, insurers need to partner with government, policymakers and industry associations to drive change. And the work that we're thinking about is really investment in mitigation, thinking about the policy settings, and thinking about what do we need to change now to protect in the future. So the government plays a really important role, but from a regulatory perspective, we have high expectations of our insurers to be thinking about the risks they face and managing them appropriately.
Okay. I think we have more questions to Ms. Suzanne, but before we continue, can I ask Hakimul Batih about green bonds and sustainable investment instruments that currently gaining traction more globally? And what are some practical strategies or policy tools that can accelerate their adoption in insurance market, especially here in Asia?
Yeah, I will start to offer the 3 points here, but first is capacity building. Capacity building is a must. With capacity building, for example, learning session, knowledge sharing from the other country is very important. And we, as OECD, we will support on that. As Ms. Geraldine mentioned in the presentation, that we already do the serial of capacity building, sharing session on the energy saving insurance. Second, I think this is very important point this morning, but Julius has mentioned about break down the silo. And this is very important because the coordination is very, very expensive in Indonesia. And I believe that OJK and also Ministry of Energy having start that thing to collaborate together to do like a policy, streamlined policy that, for example, support the government target. For example, support the national determined contribution target. One thing, the example is like energy saving insurance. Third is, I would like to highlight the term of seeing is believing. So, yeah, maybe there are theory, there are a concept happen in the other part of the world, but not necessarily happen in Indonesia, right? So the pilot project is very important. So under the task force, under the roadmap, we would like to invite also to insurance company in Indonesia to do a pilot project. Please contact OJK and also MMR, and we do together. Thank you.
Okay. I think the question has been answered by Suzanne. I think we can go on the next question. I think the operators, this one. But while waiting for that, let me continue with Pak Hakimul. I think let's talk about the challenges.
Okay.
I think many insurers are committed to ESG principles, at least want to commit if not committed, but face practical challenges in compliance and implementation. What advice would you have to regulators, industry leaders in navigating the balance between ESG ambition and operational financial capabilities? Because every company have different size.
Yeah. Got the point, Pa. Before discussing the balance between ESG ambition and also financial capability, I would like to highlight the term sustainability. Sustainability, it's mean not only now, but also we consider the future. So if we talk about the profit, then we have to consider the long-term profit. And then on the how to balance, the advice for the leaders, I think we can start with identify the project in each sector. Different sector have different characteristic of project. Then company with different sense can choose what sector that suit with them, because the challenges is different in different sector. So by identifying the project in different sector, they can choose what suit the size of the company. Thank you.
Okay. It's a bit mixed, I think. Is this question to Geraldine or question to maybe I think Suzanne? I mean, what is the regulation for insurance company to invest in nature-based solution project for carbon offset towards net zero? Maybe it's related to you, Suzanne? Think more on the ESG parts, right?
It's probably, nature is an important, investing in nature, resilience is an emerging part. I think we've been talking more climate-based. Nature is starting to feature because we know it's just so central to protecting that. But it's probably not my area of expertise on sort of the investment towards net zero there. But just on the question I had before, I actually didn't answer it accurately there, because the question was about the incentive of insurers to support insurance in climate-related areas, which I think is a really challenging thing for insurers, because we expect them to price for risk. We expect them to actually understand their risk undertaking. And so asking insurers to participate in areas where the risk is greater than the appetite. So I think that part of insurers working with government to mitigate risk will stimulate the ongoing participation in insurance in those markets.
Let's continue on that. Based on your experience, how are the leading insurance effectively assessing the climate risk and natural disaster within their risk management framework?
So I think we're seeing them using modelling, so both internal and external modelling, and that's really important to start to predict where those risks might emerge. I think the insurance climate vulnerability assessment will be a really important tool, because we're gathering data to be clearer on trying to identify those areas. But data poses its own risk in some ways, because pooling underpins the concept of ensuring that everyone contributes something to protect, the contributions of many protect the claims of the few. But as we're moving to more granular data, it's almost becoming more challenging in that it can be exclusionary. So I think that ongoing modelling is central for insurers.
But if you implement that, would that work in Indonesia? Because geographically, our location is prone to all natural disasters, climate risk is all inevitable for us, right? Is there anything you can share in terms of the best tools to do?
Well, we're one big island, you're lots of islands. So it's a very challenging geographic tool, but I think that ongoing, the economic modelling that's available, building internal modelling, looking to reference points will be clear.
All right. Next question is, what are the available options of renewable energy investment that we must consider? I think it's for Hakimul Batih.
Thank you. To respond on that, I think we have considered 2 points. First is on technology. If we talk about the ready technology, the technology that already ready now, maybe the answer is hydro and geothermal. And in the future, we have to look at for example, at PLN or Ministry of Energy plan. They will consider more on solar PV. And if we go beyond that, for example, after 2030, 2035, green hydrogen maybe will be we have to consider on that. Thank you.
Right, but we'll face practical challenge because when you say hydro and geothermal, it's a bit of a high risk from the insurance perspective. But anyway, let's go to the next question. Closing the protection gap requires community confidence in the financial system. What role can regulators such as APRA play building this confidence?
That's a great question. The protection gap is a huge challenge for every economy around the world. And as we saw, our protection gap is growing, but emerging economies are facing the fact that they don't really have low penetration for insurance. I think trust is a really important term. We heard that mentioned earlier. Trust and confidence underpins insurance. I think financial literacy was called out as a real issue. We in Australia have compulsory insurance. So there are many areas such as if you hold a car license, you must have compulsory third-party insurance to protect others who are on the road with you. We have compulsory insurances for running a business to protect your customers from hurt or harm. We have compulsory health insurance in that you're taxed if you don't hold health insurance. So there's a lot of scaffolding that underpins a base level. But I think in many countries it's about education, it's about awareness. I think starting to build that with our young people. Then the other side is trying to reduce risk in the countries so that we can bring the price down. And we're seeing premiums increase because the risks in countries are increasing. And that's why investing in adaptation, land use planning, sensible policies are not the problem of the insurance companies alone. It's about governments and policymakers and working across the world. And the IAIS is doing a lot of work collaboratively around the world to think about how learnings can be shared to be implemented in other countries.
Yeah, I mean, we have the foundation. I mean, I think obviously Australia have better scaffolding. I mean, but we're getting there. I mean, we don't have the compulsory, but I think between the association and the OJK, we're working towards 1 or 2 compulsory insurance that probably become our scaffolding. The next is, in a world where major economies like the US are retreating from ESG, is it really? How can Indonesia maintain momentum and ensure these policies drive real impact? I think it's Hakimul. I think between us and the US keeps trying to pull themselves out of this, but we need to maintain somehow.
I mean, we're seeing that we're involved in global associations. I think the US might have pulled out of the NGFS, the Network for Greening the Financial System, but we're continuing to work on important papers like adaptation risk and transition planning, because climate risk doesn't go away just because you say it's not there.
Just because Trump said
Just because Trump. So I think the rest of the world needs to continue to march forward. Working with Indonesia is a privilege from Australia to try and support that work. And as part of the IAIS, I sit around the executive table with the rest of the world, and there are many people in the US that still believe in the work, so it's not stopping. We just have to continue to forge ahead.
Just go into the case studies. Can you share some good case studies where insurance have or successfully integrated ESG into their core business models?
Yeah, well,
not just reporting though, in underwriting and product designs.
Yeah, so we do have one insurer that I can share a case study on who invests in data and modelling to inform and price, risk. And so what they're looking at doing is they've developed internal rules about screening certain criteria for sectors of investment. So an example is restricting the ability to both invest in and underwrite activities relating to fossil fuels. Because if you're investing in that and then you're underwriting and protecting against it, you get the concept of double materiality. So it's trying to sort of reduce the impact of harm on both ways. So it's really thinking about what those criteria are that you can look at to alert you to where the risks are happening. And I think that's a good first step that we're seeing in Australia and starting to build that both into the investment side and the underwriting side.
Okay, I think we're about to end. The last question for Pak Hakimul Batih. From a policy and investment perspective, how would you define sustainable insurance in the context of emerging markets like Indonesia? Why is aligning insurance with green finance is no longer optional, but actually an essential for economic resilience? And can you provide an example for that?
Yeah, as Geraldine mentioned in her presentation, that the losses on the climate change is increasing, right? And I would like to highlight the term that green financing, energy transition. The term is like a wave. It will hit us. If we cannot prepare and we cannot surf on it, we'll be left behind. And if left behind, in the future, they will be more costly to adopt. So it's not option anymore. We have to start now. Because if we left it behind, then we'll be costly to adopt in the future. For example, I back to the example of the energy saving insurance. In Latin America, in Colombia, in El Salvador, and also in Mongolia, they developed the energy saving insurance is because of increasing demand of energy, and they try to mitigate by increasing the energy efficiency. But there are no support on that. And finally, they developed the energy saving insurance. And now they become new market in energy saving insurance. So first, we would like to message that this is not any more option, but this is a must for us to starting now, because this will be a new market in the future. Thank you.
Okay. Bapak, Ibu, ladies and gentlemen, I think we have come to an end of our presentation. Thank you very much for Mrs. Geraldine Ang for videotape. Thank you, Ms. Suzanne, for delivering your great presentation. Thank you, Pak Hakimul Batih, for the discussion. Thank you.